studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
So far in this course, we've focused primarily on Canadian source income. We've looked at interest income, rental income, dividends, capital gains, corporate tax payable, and refundable tax accounts. But what happens when a Canadian corporation earns income outside of Canada? This is where international taxation begins. And with international taxation comes a major challenge: double taxation. Let's start on the left side of the slide. Imagine that Barnes Dentistry earns income from a foreign source. Perhaps the corporation owns investments in another country. Perhaps it receives foreign dividends. Or perhaps it earns foreign business income. In this example, the corporation earns $10,000 of foreign income. At first glance, this seems straightforward. Income is earned, and tax must be paid. But now a problem appears. The foreign country where the income was earned may claim the right to tax that income. And Canada may also claim the right to tax that same income because the corporation is a Canadian resident. Now look at the center of the slide. This is the double taxation problem. The foreign country taxes the income first. In our example, the foreign tax paid is $2,000. But the story doesn't end there. Because Barnes Dentistry is a Canadian corporation, Canada may also include that foreign income in its Canadian tax calculations. Without any relief, the same $10,000 of income could be taxed twice, once by the foreign country, and once again by Canada. This is why the warning symbol appears in the center of the slide. Double taxation increases the total tax burden and can create unfair results. Imagine earning $10,000 of income, but having two different governments tax the same earnings. That would discourage international investment and make cross-border business activities much more difficult. Fortunately, the Canadian tax system provides a solution. Now look at the right side of the slide. This solution is called the foreign tax credit, and the primary schedule used to calculate it in the T2 return is Schedule 21. Think of Schedule 21 as a tax relief mechanism. It recognizes that tax has already been paid to another country. Instead of ignoring that foreign tax, Canada may allow the corporation to claim a credit. That credit can reduce Canadian tax payable. As a result, the corporation receives relief from double taxation. Notice the green shield labeled foreign tax credit. The shield is a good visual representation of what the credit does. It protects the corporation from being taxed twice on the same income. Now let's look at the simple definition panel. A foreign tax credit is tax relief for taxes already paid to another country. That's the easiest definition to remember. If foreign tax has already been paid, Canada may recognize that tax and provide relief through Schedule 21. The purpose of the credit is not to eliminate all tax. The purpose is to prevent the same income from being taxed twice. The balance scale shown on the right side of the slide represents fairness. The Canadian tax system attempts to create a balanced outcome by recognizing taxes already paid abroad. Now look at the flow diagram along the bottom. The corporation earns foreign income. The foreign country taxes that income. Canada also has the ability to tax the same income. Without relief, double taxation occurs. Schedule 21 intervenes by allowing a foreign tax credit. The result is a fairer tax outcome and a reduction in Canadian tax payable. The message at the bottom of the slide captures the entire concept. Foreign tax paid does not necessarily mean lost tax. Instead, that foreign tax may create a valuable tax credit. The key takeaway from this slide is simple. Schedule 21 exists to prevent double taxation. When a Canadian corporation earns foreign income and pays foreign tax, Canada may provide relief through a foreign tax credit. That credit helps ensure that the same income is not taxed twice and allows international business and investment activities to be taxed more fairly. In the next step, we'll see exactly how Schedule 21 calculates the foreign tax credit and how foreign taxes paid are converted into Canadian tax relief. Now that we understand why foreign tax credits exist, let's look at how Schedule 21 actually works. The purpose of Schedule 21 is straightforward. It takes information about foreign income and foreign taxes paid and converts that information into a foreign tax credit that can reduce Canadian tax payable. Think of Schedule 21 as a tax relief calculator. Its job is to determine how much credit the corporation is allowed to claim. Let's start on the left side of the slide. In this example, Barnes Dentistry earns $10,000 of foreign income. Because the income was earned in another country, the foreign government taxes that income first. The corporation pays $2,000 of foreign tax. At this stage, we have two important pieces of information: foreign income of $10,000 and foreign tax paid of $2,000. These two amounts become the starting inputs for Schedule 21. Now let's move to the center of the slide. This is where Schedule 21 performs its calculation. The schedule receives information about the foreign income earned and the foreign tax already paid. The goal is to determine how much of that foreign tax can be recognized by Canada. Notice that Schedule 21 is not simply asking how much foreign tax was paid. Instead, it is comparing two different amounts. The first amount is the Canadian tax that would otherwise be payable on the foreign income. The second amount is the actual foreign tax paid. This comparison is important because Canada does not automatically allow every dollar of foreign tax to become a credit. Instead, a limitation rule applies. The allowable foreign tax credit is generally the lesser of these two amounts. This is one of the most important concepts in the entire foreign tax credit system. Let's use the numbers shown in the example. Foreign income is $10,000. Foreign tax paid is $2,000. Assume that the Canadian tax otherwise payable on that foreign income is $2,500. Since the foreign tax paid is lower than the Canadian tax otherwise payable, the full $2,000 may be allowed as a foreign tax credit. That amount becomes the allowable credit. Now look at the right side of the slide. The allowable foreign tax credit is shown as $2,000. This credit is claimed on the corporation's T2 return. The result is a reduction in Canadian tax payable. Notice the green shield beside the credit amount. Just like we saw in the previous slide, the shield represents protection against double taxation. The corporation has already paid tax to the foreign country. Schedule 21 ensures that Canada recognizes that payment and provides appropriate relief. Now let's examine the FTC Limitation Rule shown in the orange panel. This rule is extremely important for tax preparers. The foreign tax credit cannot exceed the Canadian tax otherwise payable on that foreign income. In other words, Canada will not generally provide a credit larger than the amount of Canadian tax associated with the foreign income. This prevents the credit from creating an excessive tax benefit. For example, imagine the foreign tax paid was $4,000, but the Canadian tax otherwise payable on that income was only $2,500. In that situation, the allowable credit would generally be limited to $2,500. The excess foreign tax would not create additional current year Canadian tax relief. This limitation principle appears frequently in both corporate and personal foreign tax credit calculations. Now look at the flow diagram across the bottom of the slide. The process is simple. Foreign income is earned. Foreign tax is paid. The information is entered into Schedule 21. The foreign tax credit is calculated. The allowable credit is claimed on the T2 return, and Canadian tax payable is reduced. This is the complete purpose of Schedule 21. The message at the bottom summarizes the concept perfectly. Schedule 21 turns foreign tax paid into Canadian tax relief. That's exactly what the schedule is designed to do. The key takeaway from this slide is simple. Schedule 21 collects information about foreign income and foreign taxes paid, applies the foreign tax credit rules, and determines the amount of credit that can reduce Canadian tax payable. By doing so, it helps prevent double taxation and ensures that foreign taxes already paid are recognized within the Canadian corporate tax system. In the next step, we'll zoom out and look at the complete foreign tax credit system from beginning to end, showing how foreign income ultimately flows through Schedule 21 and reduces Canadian tax. We've now reached the final step in our discussion of foreign tax credits and Schedule 21. Up to this point, we've learned why double taxation can occur and how Schedule 21 calculates a foreign tax credit. Now let's step back and look at the complete process from beginning to end. This slide shows the entire journey of foreign income through the Canadian corporate tax system. Let's begin at Stage 1 on the left side of the diagram. The process starts when a Canadian corporation earns foreign income. In our example, Barnes Dentistry earns $10,000 from a foreign source. This could be foreign investment income, foreign business income, foreign dividends, or another type of foreign source income. At this point, the corporation has earned income outside Canada, but no tax relief has been calculated yet. The next step is Stage 2. The foreign country taxes that income. In our example, the corporation pays $2,000 of foreign tax. This payment is made to the foreign government's tax authority. Now the corporation faces the possibility of double taxation. The foreign country has already taxed the income. But because Barnes Dentistry is a Canadian corporation, Canada may also tax that same income. This is the exact problem that Schedule 21 is designed to solve. Now move to Stage 3. The corporation gathers its foreign income information and records the foreign taxes paid. That information is entered into Schedule 21. Think of Schedule 21 as the calculation center for foreign tax credits. It receives the foreign income amount. It receives the foreign tax amount, and it applies the foreign tax credit rules. This is where the corporation determines how much Canadian tax relief may be available. Next, we arrive at Stage 4. The foreign tax credit is calculated. Using the limitation rules, Schedule 21 determines the allowable credit. In our example, the allowable foreign tax credit is $2,000. Remember the key rule. The credit is generally limited to the lesser of the foreign tax paid and the Canadian tax otherwise payable on that foreign income. This limitation ensures that the credit provides relief without creating an excessive tax benefit. Now let's move to Stage 5. The allowable foreign tax credit is claimed on the corporation's T2 return. This is where the benefit becomes real. The credit directly reduces Canadian tax payable. Notice the shield symbol in this section. The shield represents protection against double taxation. The corporation has already paid tax to the foreign country. Canada recognizes that payment and provides relief through the foreign tax credit. As a result, the corporation avoids paying full tax twice on the same income. Finally, we arrive at Stage 6, the final outcome. Because the foreign tax was recognized through Schedule 21, the corporation receives a fairer tax result. The foreign tax is acknowledged, Canadian tax is reduced, and the risk of double taxation is significantly lowered. The balance scale shown in this section is an excellent symbol of what the foreign tax credit system is trying to achieve. Fairness. The Canadian tax system attempts to balance the rights of both countries while ensuring that taxpayers are not unfairly taxed twice on the same income. Now let's look at the journey summary along the bottom of the slide. The corporation earns foreign income. foreign tax is paid. Schedule 21 is completed. A foreign tax credit is calculated. Canadian tax is reduced, and the corporation arrives at a lower final tax payable amount. This simple sequence is the mental model every tax preparer should remember. Foreign income, foreign tax. Schedule 21, foreign tax credit, reduced Canadian tax. The panel on the right explains why this system is so important. Foreign tax credits encourage international investment. They reduce barriers to global business activity. They help prevent double taxation, and they promote fairness within the international tax system. Without foreign tax credits, many international investments would become much less attractive because the same income could be taxed repeatedly by multiple countries. The message at the bottom of the slide summarizes the entire concept perfectly. Schedule 21 ensures that foreign taxes paid are recognized within the Canadian corporate tax system. That's the purpose of the schedule. That's the purpose of the foreign tax credit. And that's the purpose of the entire system. The key takeaway from this slide is simple. When a Canadian corporation earns foreign income, pays foreign tax, and reports that information through Schedule 21, Canada may provide a foreign tax credit that reduces Canadian tax payable. This process helps prevent double taxation and creates a fairer international tax result. And with that, we've completed the complete foreign tax credit flow. Foreign income, foreign tax paid. Schedule 21, foreign tax credit, reduced Canadian tax. A simple but extremely important concept for every corporate tax preparer to understand.